They told us inflation was under control. We've heard it over and over again from politicians, central bankers, and media pundits. Inflation is cooling down. The worst is behind us. The economy is stabilizing. But if you walked through a grocery store recently or tried to rent a new apartment, you know the truth. Something still feels very wrong. Prices haven't come down. They've just stopped rising as fast. Your paycheck doesn't stretch like it used to. And despite all the talk of progress, it feels like the middle class is still under siege. Let's unpack what's really happening behind the headlines. The illusion of control. What the Federal Reserve and government want you to believe. The Federal Reserve, the central bank of the United States, has paused its interest rate hikes. This was seen as a signal that inflation is under control. The media echoed this sentiment, celebrating the decline in the Consumer Price Index, CPI, the official measure of inflation. CPI dropped from over 9% in mid-2022 to below 4% in 2024. Sounds great, right? But here's the catch. A drop in inflation doesn't mean prices are falling. It just means they're rising more slowly. Understanding price stickiness. Imagine this. In 2021, a dozen eggs cost $2. In 2022, due to inflation, they jumped to $4. In 2024, inflation drops. But now those eggs cost $4.10, not $2 again. That extra cost? It's not temporary, it's sticky. This is known as price stickiness. The tendency of prices, especially for essentials, to stay elevated even after the economic pressures that caused the initial increase have faded. This phenomenon is particularly devastating for the middle and lower classes, who spend a larger share of their income on necessities. What the data hides. The CPI is often misleading because it averages out many categories. While tech gadgets or used cars might drop in price, that doesn't help if rent, food, and healthcare, the stuff you actually need, keep rising. Let's break it down. Housing. Rent is still increasing in most major urban areas. There's a housing shortage and demand remains high. Healthcare. Health insurance premiums rose almost 7% in just the past year, outpacing wage growth for most people. Food. Since 2020, the price of groceries has increased over 20%, and those prices haven't come back down. Even essentials like bread, milk, and meat are significantly more expensive than they were just a few years ago. So while Wall Street celebrates the CPI slowdown, Main Street is still hurting. Why this feels permanent. This inflation isn't just a leftover from the pandemic. It's become structural, built into the economy itself. Key reasons. Corporate pricing power. Many companies learned during the pandemic that consumers would tolerate higher prices. They haven't looked back. Labor shortages. There aren't enough workers in key sectors. Wages have risen, but not enough to offset the cost of living. Global instability, ongoing wars, supply chain issues, energy volatility, and trade conflicts have kept pressure on prices worldwide. The Federal Reserve's dilemma. The Fed is in a no-win situation. If they lower interest rates too soon to stimulate growth, inflation could flare up again. But if they keep rates high, borrowing becomes more expensive, business investment slows, and the economy risks a recession. It's a tightrope walk, and the consequences will be felt most by ordinary people. Who pays the real price? Inflation is a hidden tax, and it doesn't affect everyone equally. Here's who gets hurt the most: low and middle-income families. They spend most of their earnings on essentials, food, housing, gas, and have little left over to save or invest. Retirees on fixed incomes, their Social Security or pension checks don't increase fast enough to match the real rise in prices. Young adults, many are stuck renting, unable to afford homes, while also juggling student loan payments and rising living expenses. And who benefits? The wealthy, those who own assets like stocks, real estate, and collectibles, often gain value during inflation. These assets rise with prices, insulating them from the daily pain most people feel. What you can do: smart moves in a sticky inflation era. You can't control the global economy, but you can prepare yourself and build a strategy that helps you survive and even thrive in this environment. 1. Track your finances like a business. Start treating your household like a company. Track every expense. Inflation hides in small repeat purchases: coffee, takeout, streaming services, subscriptions. Awareness is your first defense. 2. Invest in inflation-resistant assets. Look for places to put your money that tend to hold or grow value during inflation. Examples: REITs, real estate investment trusts. Real estate often rises in value as inflation climbs. Commodity ETFs, funds tied to the price of oil, gas, metals, or agriculture. Dividend-paying stocks, companies with strong balance sheets and consistent payouts, can help offset rising costs. 3. Avoid bad debt. Stay away from high-interest credit cards or variable-rate loans. They become especially dangerous in an inflationary environment. Stick to fixed-rate debt if you must borrow, and focus on paying down what you already owe. 4. Stay informed, not just entertained. Mainstream headlines are often late to the real story. Dig deeper. Follow independent economists, real-time data sources, and long-term trends. Inflation might not dominate the news cycle anymore, but it's still shaping your life. The crisis isn't over. It just got quiet. The current economic climate has shifted from loud, obvious panic to something quieter and more insidious: It's not a fire anymore. It's a slow burn. So if you care about your financial future, your family's security, or your long-term independence, don't tune out. Don't get comfortable. Stay sharp. Stay prepared.